One man, the worst crash in history. $100 million in profit. This is the story of Jesse Livermore, the man who turned financial disaster into the greatest trade Wall Street has ever seen. Jesse Livermore was not born into money. He was not handed a trust fund. He did not attend a prestigious university. He grew up in rural Massachusetts in 1877, the son of a farmer who could barely feed his family through the winter. At the age of 14, he made a decision that most adults would never dare to make. He packed a small bag, took $5 from his savings, and walked away from his father's farm without looking back. He had no plan beyond one destination, the financial district of Boston. He walked into the offices of Payne Webber and asked for any job available. They gave him the lowest possible position, a board boy. His task was simple. As stock prices came in over the ticker tape, he would write them on a large chalkboard for traders to see. To everyone else in that room, those numbers were just prices. To Jesse, they were a language. He began recording every number in a personal notebook, not just the prices themselves, but the timing between price changes, the size of each movement, the speed at which prices accelerated or slowed. Within months he had filled several notebooks, and a pattern had emerged that would define his entire career. Prices were not random. They behaved, they signaled, they followed a logic that was invisible to emotional traders but completely visible to anyone disciplined enough to study them without bias. Jesse had discovered something that most professional traders never find in a lifetime. At 15, Jesse began testing his observations in bucket shops. These were unofficial trading rooms scattered across Boston where people could place bets on whether a stock price would rise or fall. No real shares were exchanged. It was speculation in its rawest form. Most people who walked into bucket shops lost money. Jesse walked in and started winning immediately, and he did not stop. His $5 became 50. 50 became 500. 500 became 1,000. By his 16th birthday, he had turned his original stake into over $10,000, all from reading price movements that other traders completely overlooked. The bucket shop owners noticed. A teenage boy was systematically draining their profits every single day. One by one, the shops began refusing to accept his trades. Some put his description on a list and shared it with other establishments across the city. Jesse responded by disguising himself. He changed his clothing, altered his walk, used false names, and sometimes sent other people in to place trades on his behalf. The lengths he went to just for the opportunity to trade revealed something fundamental about his character, an obsession with a market that went far beyond money. He was not trading for excitement. He was not trading out of greed. He was solving a puzzle that consumed him completely. The money was simply the scorecard that confirmed he had solved it correctly. When Jesse eventually moved to New York and began trading on the real stock exchange, he carried with him a set of principles that he had developed through years of meticulous observation. These were not theories he had read in books. They were rules carved out of real experience and real losses. The first rule was this: never trade against the direction of the market. Most people try to be clever. They try to buy when prices are falling, believing they are getting a bargain. Jesse understood that a falling price is a signal, not an opportunity. It means something is wrong. The market is telling you to stay away, and ignoring that signal is one of the most expensive mistakes a trader can make. His second rule was equally powerful: never average down on a losing position. If a trade moves against you, the instinct of most people is to buy more at the lower price to reduce their average cost. Jesse believed this was financial suicide. A losing trade is evidence that your analysis was wrong. Putting more money into a wrong position does not make it right. It makes the eventual loss far larger. His third rule was patience. Jesse would sometimes identify a trade and then wait weeks before acting on it. He was waiting for what he called the pivotal point, the precise moment when the price confirmed that the move he anticipated was actually beginning. Entering too early was just as costly as entering too late. These three rules sound straightforward. They are extraordinarily difficult to follow because they require you to act against your emotions at every critical moment. When your instinct says buy the dip, Jesse's rules say walk away. When your instinct says hold on and wait for recovery, Jesse's rules say cut the loss immediately. He understood that the market does not reward the hopeful, it rewards the disciplined. In 1906, Jesse made a trade that established his reputation as someone who saw what others could not. The American economy was expanding aggressively. Business confidence was high. Markets were climbing. There was no visible reason for pessimism. The financial press was uniformly optimistic, and most traders were fully invested in expecting further gains. Jesse noticed something different. In the price action of several major stocks, he observed a subtle but unmistakable slowing of upward momentum. Prices were still rising, but they were rising with less conviction than before. The buying pressure was weakening at a time when most people believed it was stronger than ever. He built a short position, a bet that prices would fall. Everyone around him thought the trade was misguided. The economy showed no signs of weakness. There was no reason visible to the public eye for a market decline. Then the San Francisco earthquake struck. The catastrophe devastated one of America's most important cities and sent financial markets into immediate decline. Jesse's short position produced a profit of $250,000. He had not predicted the earthquake. He had read a weakness in market structure that told him a decline was coming regardless of the cause. The earthquake simply accelerated what the market had already been signaling. This distinction is critical. Jesse did not win because he was lucky. He won because he had learned to read the market without needing to know the reason behind its movements. The panic of 1907 gave Jesse his first taste of truly massive profits. Throughout 1906 and into 1907, Jesse had been tracking something alarming in the American financial system. Banks were lending at extraordinary rates. Investors were borrowing heavily to speculate in stocks. The ratio of borrowed money to real assets in the market had reached levels that Jesse had never seen before and that history had never seen before. He understood intuitively what modern economists would later confirm mathematically: when a financial system relies too heavily on borrowed money, the eventual unwinding of that debt does not happen slowly and gently. It happens suddenly and violently. He positioned himself for a severe market decline months before it happened. Friends questioned his judgment. Even traders who respected his track record told him he was being overly cautious. In October 1907, the system broke. Banks began failing across the country. The stock market collapsed with a speed and force that paralyzed the financial world. The panic was so severe that J.P. Morgan himself had to personally organize a private rescue to prevent the complete collapse of the American banking system. Jesse Livermore walked away from that crisis with over $1 million in profit. He was 30 years old. No university had taught him this. No mentor had guided him. He had built his edge entirely through observation, discipline, and the willingness to act on his conclusions when every voice around him said he was wrong. By the late 1920s, Jesse Livermore had lived through multiple market cycles. He had made fortunes and lost them. He had rebuilt from zero twice. Each cycle had sharpened his understanding of how markets behave at extremes. What he witnessed throughout the 1920s alarmed him deeply. The Roaring Twenties had created a mass delusion about the stock market. Ordinary people with no financial knowledge were borrowing everything they owned to invest. Stock prices had risen to levels that bore no relationship to the actual earnings of the companies behind them. The entire market was floating on a foundation of borrowed money and collective fantasy. Respected economists declared that stocks had reached a permanently high plateau. Major banks published reports urging the public to keep buying. Newspaper headlines celebrated the endless prosperity of the American economy. The more confidently the public believed the party would last forever, the more certain Jesse became that it was almost over. He began building his short position in early 1929. The process took months. The scale of what he was doing had to remain completely hidden because the size of his trades was large enough to move markets if discovered. He worked in silence, methodically, while the public continued buying and the market continued rising. The market kept climbing after he had positioned himself. Doubt crept in. People around him questioned whether he had finally lost his judgment. The financial press was unanimously bullish. Every piece of visible evidence seemed to argue against his position. Jesse held firm. He had been here before. He knew that the final phase of a speculative bubble always feels the most convincing. Prices rise fastest just before they collapse. Confidence peaks at the exact moment the foundation underneath is crumbling. On October 24, 1929, the market began to break. Black Thursday opened with panic selling that overwhelmed the system. Over the following days and weeks, the market declined by nearly 90% from its peak. Businesses destroyed overnight, retirement savings gone, families wiped out in hours. Jesse Livermore collected over $100 million. In today's money, that is approximately $1.7 billion earned in weeks, from a position built through years of reading, thinking, and waiting with absolute patience while the world told him he was wrong. The market will always crash again. The question is, will you be ready, or will you be the one losing everything? Subscribe. The next lesson could change everything.